Welcome to this edition of the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Erik Ainge, your host. And today I want to take you somewhere most financial radio shows refuse to go. In fact, never heard one do this before. We're going to go to the casino floor. That's right. Insert the tunes. That's right. Not to gamble, not to win big, not to chase a hot streak. We are going so I can show you something the house spent the last 100 years trying to hide. The casino's not afraid of lucky people. The casino is afraid of math. And by the end of this hour, you're going to understand why that single sentence may be the most important investment idea you hear all year. Joining me, as always, the brain trust of Tennessee Wealth Management, except Jared and Amber, they're not here with us, but the rest of us are. Jerry Goodman, sitting right here, 43 years in the biz, certified financial planner, and the guy who has forgotten more about portfolio construction than most advisors will ever learn. His daughter, Megan Hubbard, also with us, part of the team, former first grade teacher at CAK, has a master's degree in curriculum and instruction, which is why she is the only one of us who can explain the really hard things without putting an audience to sleep. Keep little kids listening. She can keep us listening as well. And, of course, Susan, my wife, rounding out the table. And that's your Tennessee Wealth Management team, bringing you the Organized Investor Show. She's currently studying that Series 7, which means she gets paid to study, and I get to do the dishes. And somehow, I don't think that's awesome, but thanks, Jerry, because that's why that's happening. For folks who haven't met me before, played quarterback at UT, then for the New York Jets, and now my biggest blitz comes from an almost 2-year-old TD, or Leaf, as Jerry calls him, asking for snacks at 6 in the morning. All right, Megan, set the stage for me. In the world of card playing, what does a card counter actually do?
Well, a card counter doesn't beat the casino with luck, Erik. He actually beats it with arithmetic. That's like a fancy word for math, by the way.
Thank you for also helping me with that.
Just wanted to make sure we knew
I'm a football player.
Our vocab.
Shazam.
Every card that comes out of the shoe shifts the odds, okay? And the counter is just keeping a running tally in his head. And when the deck gets rich in tens and aces, the player suddenly has a tiny mathematical advantage, usually somewhere between 1% or 2%. That's it. 1%. And that 1% is the entire reason casinos throw card counters out, ban them for life, and have whole rooms of people watching cameras to find them, because the house was built on a 1 to 5% edge over the average gambler, and they cannot stomach the idea of someone flipping that math around on them.
And that's the part that most people really miss, Megan, because every single casino on Las Vegas Strip, okay, the marble lobbies, the chandeliers, the fountains, the helicopter pads, all that, it was built on that edge of that 1 to 5% that you're talking about. It's not the jackpots. It's not the whales, or on a small mathematical repeatable advantage applied to millions of hands per year, every year for decades. That's where this is coming from, okay? That's exactly how a real portfolio is built over a 30-year retirement. And once you see it, you really can't unsee it. Retirement is not a guessing game about which stock pops next quarter or which sector is on the hot cover of a magazine, okay? It's a hands played over time math scenario.
And the question Erik wants to ask today, Jerry, is the one nobody wants to answer. Which side of the table are you actually sitting on? Because most people listening right now think they're playing the game. Well, they're not playing the game. They are the game. They are the average gambler the casino was built to beat. And most of them sat down 20 years ago and never once looked up to check the math.
That is exactly the conversation that I want to have today. Now, before anybody panics, this is not a show about gambling. Texas Tech football fans, don't worry about that. We're not telling anybody to roll the dice with their nest egg. What we are doing is borrowing a framework math the casino has used to print money for 100 years and applying it to how this team actually manages money. And here is the unfair advantage they have, the one most listeners never get to peek at. Their numbers are public. Megan, walk us through the scoreboard. Set hut.
I will be happy to do that. I have no idea what set hut means, but I guess it means go. So anyway, anyone listening can go to theorganizedinvestor.com. Right now, you can click on the performance and you can see the actual results posted right there on our website. And these aren't theoretical numbers. They are tied to real client accounts with the last 4 digits of those account numbers listed for verification. You can quite literally check the receipts. If you're one of our clients, you can go on and find the last 4 digits of your account and see your numbers right there. Trailing 1-year returns are 36.3% compared to 13% for the Dow Jones average. The 3-year average is 19.3% annually. You have a 5-year average at 13.3%, and 7-year average is 16.7%. This is net of fees, okay? This is what's coming home in your pocketbook. Your pocky purse, as my friend growing up used to say, her pocky
Real
purse.
money.
Real money, real clients, and real accounts. That's what you're getting here.
I want to be very clear about why those numbers look the way they do, okay? This isn't luck. This is not a hot streak. This is not Jared and I sitting around just picking stocks because we have a feeling on Tuesday. Those returns come from being selective in a lot of different areas. They come from owning roughly 95 individual stocks at the moment, each with about 1% in the portfolio. We are not buried in 7,000 stocks through 25 or 30 different mutual funds. That is not diversification. That's what we like to refer to as diversification.
Dun, dun, dun.
And it's really the silent killer of a lot of long-term returns because you're just over-diversified.
And let me explain diversification in plain English. For anybody who hasn't heard us use this term before, which is shocking. If you've listened to us at all, you've probably heard this, but let's talk about it. If you own 5 mutual funds, you might think you're diversified. This is probably what you've always been told to do, is to diversify. But 3 of those funds probably own the same 100 large American companies in slightly different proportions. Now, by the time you add them up, you basically own the entire S&P 500, except you're paying 5 different management fees to do this. You haven't diversified at all. You've just made yourself more expensive. That is why so many portfolios look incredibly busy on paper and produce mediocre results in real life.
And that's exactly right, Megan. The second piece of that, and this is really where in-house management really matters, is that Jared and I were basically sitting in the same office, looking at the same data, making decisions for these clients, okay? There's no committee in some other time zone. There's no fund manager you've never met making changes inside of a big black box. If something happens in the market on, say, a Tuesday, we can act on it Tuesday the same day. That is what's called flexibility. That's what it looks like in real life. A mutual fund can't do that. Same thing for a robo-advisor. A guy 300 miles away who has to call you twice a year can't do that either.
And I think this is where the casino math really clicks for me. The casino doesn't try to hit a home run on every single hand. They don't need to. They just need their tiny edge to show up over enough hands. That is exactly how Jared and Jerry are running money over here. Small, repeatable advantages applied over thousands of decisions and decades of holding periods. That compounds into real wealth, and it does it without the drama.
And I want to underline one thing about that scoreboard before we move on. We don't just post the good years. We don't post a glossy brochure with one cherry-picked, time horizon. We post the trailing 1, 3, 5, 7-year numbers all at once with the last 4 digits of real accounts so anyone can verify them. You will not find another advisor doing that. You just won't. You can search for hours. The real reason is simple. Most advisors do not actually know what their own performance numbers are. And the ones who do know it usually have a reason not to publish it.
And those numbers, 36.3% over the last year, 19.3% over 3 years, 13.3% over 5, and 16.7 over 7, those actually reflect a real philosophy, not a marketing pitch. The team is not running a fund. They're running individual portfolios for individual families. Every position you own directly. You see it on your statement. It has your name on it. That is fundamentally different from buying a slice of a mutual fund where 10,000 people are along for the ride and, the manager has to think about all of them at one time.
Oh, and an important note there too, Jared and Jerry, they're doing this with their own portfolios, not just telling you what to do. They put their money where their mouth is. All right, I'm going to stop here for a second because I want to make sure people understand the stakes since we're talking about the casino. This is the 2% message that we hammer on this show, and you've heard us talk about it, and you'll hear us talking about it, and I'm going to keep hammering it until the entire state of Tennessee understands it. I don't actually care where you're listening. We can help you. If they can improve a portfolio's net performance by just 2% a year on $1 million account, that works out to $485,000 additional dollars over 20 years. Not because 2% is huge in any given year, because of what compounding does to 2% over 20 Christmases, 20 birthdays, 20 long, quiet, repeating years. 2% is the difference between flying first class in retirement and flying in the cheap seats or riding the bus. 2% is the difference between leaving something for the grandkids and barely covering the property tax. That is the entire game right there.
And the way they get to that 2% isn't magic, Eric. It's a stack of small advantages. Lower fees is one of them. Avoiding mutual funds with internal expenses you can't see is another. Owning individual stocks instead of paying somebody else to own them for you is a third. And making selective, deliberate decisions about what they buy and when, that is the fourth. Stack 4 of those edges on top of each other and you've got 2%. That is the card counter's edge applied to a real human being's retirement.
Now this is a great moment to bring up the workshop that we do once a month, because this is where we really walk people through a lot of this, and we do it in person. We hold an organized investor workshop every month at Chesapeake's over on Parkside Drive in beautiful West Knoxville. We start at 6 o'clock. We feed everybody a real meals, maybe some adult beverages if you happen to be in the mood. And we walk you through basically a 60-page workbook we're going to give you that covers really everything we talk about on the show. We put it in one place. Eric's going to give away a football he signed, and basically to one lucky person every workshop.
Luckiest.
The luckiest, yes. And let me say clearly, because this matters, this is not a high-end steakhouse pitch, dressed to try to impress you, where we're sticking you in something you're not going to get out of for, say, 10 or 20 years. We're not setting linens on the table so we can sell you annuity at dessert. This is not who we are, and this is not what we do.
That is such an important distinction, Jerry, because the rest of the industry has perfected the dinner and pitch playbook. The fancy steakhouse, the reserved private room, the friendly speaker, and then the slow turn toward an annuity with a 10-year lockup and a surrender charge that would make your eyes water. Chesapeake's, by contrast, is a comfortable spot. The food's great, but the whole point is education. No pressure, no traps, no sign here tonight or miss out.
If you want a seat at one of the workshops, head over to theorganizedinvestor.com. Right there, super easy to find. RSVP, it takes 5 seconds. Or you can pick up the phone and call 865-415-2058. You will learn something whether you ever become a client or not. And frankly, that's the bet that we're making on you. Now let me come back to the football guy in me for just a second, because I can't help it. All right. Every quarterback who's ever played the position knows the difference between a game plan and a guess. A guess is staring across the line of scrimmage, praying that the safety jumps the right way and that you got the right call on and you hope it works. A game plan is reading the coverage, knowing the down and distance, situationally what should we be doing, trusting the math of the playbook that you've spent studying all week. The card counter has a game plan. The guy that's drinking at the slot machine, he's guessing. Right now in America, way too many retirements are being run by guys at the slot machine with a bucket of nickels and a pretty smile.
The thing that breaks my heart, honestly, is that most people don't even realize that they are guessing.
It's sad.
It is really sad. They think they're investing because they have a 401k and, a few mutual funds and a guy that they meet with every couple of years for a steak. But they've never compared their advisor to anyone else. They have never asked for a real performance number. They have never asked what they actually paid in fees last year in real dollars. This is the central problem we keep running into. People do not compare advisors.
They'll compare cars, compare houses, they compare lawn services. They'll spend a Saturday driving around to 4 car dealerships to try to save a couple $100, on a used pickup. But the same person is going to hold that same advisor for 20 years without ever once asking, well, how did we actually do compared to everybody else? Okay. That is not investing, folks. That is loyalty without any kind of verification. That is the single most expensive habit that America has in retirement.
I think it's funny that you said that people compare houses. My favorite social media is Zillow. I don't even know if that's really a social media, but
we'll call it. It counts. Just looking to
I love
look.
to get on Zillow and
that's
look.
a blast.
Like $5 million house. What's in their kitchen?
Ooh, what do they have that I want?
And what's fun is to go down the river with your Zillow thing and you look at the houses from the water side and see how much they are.
There you go.
That's not scary.
We're not nosy at all.
No.
And I think a lot of it is fear of the conversation, Jerry. People don't want to feel like they are being disloyal. They don't want to seem rude, so they just keep showing up, signing the same forms, and never actually checking the scoreboard. Meanwhile, the dealer is quietly stacking chips on his side of the table, year after year.
Folks, that is exactly the door we're going to walk through in the next segment. We're going to dig into, ready? Jerry gave me a couple words today. I already wrote them down, looked them up, so I'm going to hammer this. Ready? We're going to dig into what are called the deterministic edges and the probabilistic edges. The math you can lock in versus the math you have to play correctly. We're going to get where Jared and Jerry are leaning right now in this market, including the AI software sell-off, the Iran conflict, and how flexibility beats a mutual fund every single time. We're going to talk about the change we just made to our estate planning offer, which is a big deal, and you're going to want to hear it. And we're going to come back with the question that I started with. Which side of the table are you on? Stay with us. This is the Organized Investor Show, brought to you by Tennessee Wealth Management, and we're just getting warmed up.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
We're back. Nobody freak out. It's the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Ainge, and if you're just joining us here on the show, here's the quick version of what you missed. We are spending today building a framework around an old idea. The casino does not fear luck, it fears math. The casino was built on a 1 to 5% edge. A card counter takes that edge, flips it in their own advantage. And that's exactly the way Jared and Jerry manage real client money day after day. Quickly again, the cast: Jerry Goodman, 43 years in the business, certified financial planner; Megan Hubbard, Jerry's daughter, and the one that makes the hard stuff easy and tells us, where we need to be, what we need to do, and basically makes sure that we're all in line. And my wife, Susan, who's studying and also a part of the show in Tennessee Wealth Management, is with us as well. And me, Erik Ainge, your host, old QB, and currently doing color commentary on personal finance. All right, Megan. All right, so Megan, where did we land at the end of last segment?
Well, we landed on a really uncomfortable truth, Erik. First, we had some really hard words that I'm going to have to say here in a moment, so we'll talk about those. But we also talked about how most people don't compare advisors. They show up, they nod, they sign, and they never check the scoreboard. And the framework we are building today is casino math, and it actually gives them a way to do that comparison without feeling weird about it. Because in this segment, we're going to break down the 4 edges the team uses. 2 of them are deterministic. 2 of them are probabilistic. Good job. There we go. We should have started cheer.
You did that perfectly. Jerry told us beforehand. I'm going to work on it.
Easy for you to say.
It's probably going to be a problem to say probabilistic.
Probably.
But it's okay.
That was easy.
And if you don't know the difference between those 2 words, you don't actually know what you're paying for in your portfolio.
So let me define those terms rather clearly for everybody, because they may matter more than anything else you hear today. A deterministic edge, basically that's math that you can lock in, okay? It does not depend on the stock market going up. It doesn't depend on the economy doing anything in particular. You can change one number and the answer changes every single time in every market, okay? A lower fee is deterministic. If you cut that advisory fee by 1/4 point, that savings shows up every year no matter what the market does, okay? That's not probable. That will happen. That is arithmetic. That is basically already in the bag.
And the second deterministic edge is what we call avoiding the hidden internal cost. When you own a mutual fund, you are paying the management fee that is listed on the prospectus, sure. But you are also paying internal trading costs, fund-of-fund layers, soft dollar arrangements, and a whole stack of expenses that never show up on a single statement that you will ever see. By owning individual stocks instead of mutual funds, those costs simply go away. Subtraction. Pure subtraction. That is the second deterministic edge, and over 20 years, it's enormous.
So let me put a real number on that, Susan, if that's really your name, because I think people really gloss over this. The average actively managed mutual fund in this country has total internal costs when you include things like trading costs, soft dollars, management fees, all of that. It's going to be somewhere between 0.5% to 1%. Now, the advisor's fee on top of that is usually like another 1%. Now, you might be paying, let's say, 2% a year total. So the only number on your statement shows 1%. The other 1% is basically being quietly subtracted before you ever get to see the return. Now, compound that gap over, say, a 20 or 30-year period. Folks, that's not a rounding error. That is somebody's beach house.
All right, quick pause. Stop right there for a second because I want listeners to feel this. If a fee is being deducted from your account every quarter, that is at least a known number. You can see it. You can argue with it. You can compare it. If a mutual fund is shaving off internal expenses every single day before it ever reports a return to you, that's a hidden number. It almost feels dishonest. Both of them get subtracted from your final stack of chips, but at least you can see one of them. One of them you can't. The card counter at the table can count the cards he sees. The mutual fund investor cannot even see the deck being shuffled. That's the difference. And over a working lifetime, it is worth real money.
Now, the other two edges, the probabilistic ones, those are the fun ones. A probabilistic edge is something where you have to play your hand correctly, but you don't control whether the cards fall right in any given month. Being selective with your investments can also be a probabilistic advantage, but that's not a guarantee like reducing your fees and costs. Taking advantage of occasional buying opportunities during, some market pullbacks can be another probabilistic advantage. Both of those require judgment, experience, and the discipline to act when nobody else wants to.
They require Jared and Jerry.
Exactly.
So selectivity in our world basically looks like this. We currently own about 95 stocks with about 1% invested in each of those. We're not buried under 7,000 funds overlapping in different mutual funds, which basically is the entire S&P in a tuxedo charging you for that privilege, okay? We pick very deliberately, we hold deliberately, we trim deliberately. And some of those companies are basically dividend growth names, some things that basically pay dividends for long periods of time, companies that have that rising dividend that you know and love some of these companies. Like Lowe's, for example, has raised their dividend every year for 60 years. That's the probabilistic edge of being selective.
And the second probabilistic edge, buying bargains during fear, has been very profitable for our clients. Back in 2020, when COVID hit, everyone was selling. Our team was buying. In 2023, when the regional banks looked like they might tip over, everyone was selling. Our team was buying. In 2025, when tariffs got scary and the market wobbled, everyone was selling. Our team was buying. This year, the AI software sell-off a few months ago and the Iran conflict, same playbook. Fear creates the bargains. You just have to be the kind of investor who can show up at the table when everyone else is leaving.
And I want to point out something subtle about that pattern, okay? So the team did not predict any of those events. Nobody predicted COVID. Nobody predicted, the Silicon Valley Bank failing. Nobody predicted the tariff scare or even the AI sell-off. What the team did was prepare for fear in general. They had cash already. They had a watch list of companies they had already studied, companies they wanted to own at the right price. And when fear pushed those prices down, then they bought them. That is the difference between forecasting and being prepared. You cannot forecast the next shock. You can absolutely be ready for it, though.
And I want to dwell on the AI sell-off for just a minute, simply because it's happening right now at this time. Earlier this year, a wave of doubt entered through the whole AI sector, and some of the speculative names basically had no earnings, no business model, and basically they got hammered. Absolutely so. But the sell-off also dragged down some very high-quality companies with real customers, real recurring revenue, and pricing power that basically lets them raise their rates every year. That's what we've accumulated when prices were down here.
And the Iran piece is a great example of the other side of that coin. When that conflict heated up, two clear themes emerged. Travel-related companies, so airlines, cruise lines, hotels, they got nervous because tense geopolitics scare vacationers. Energy-related companies got a tailwind because oil prices moved up. The team did not have to bet the farm on either side. They just trimmed where they had been overexposed and added where the math improved. A mutual fund tied to a benchmark just sits there and takes whatever happens. Flexibility is not a marketing word for us. It is a daily practice.
Now, let me put this in football terms because I know somebody out there at this point in time, if you've been listening to us, you're waiting for it. The deterministic edges are like blocking and tackling, fundamentals, stuff that has to be right before you ever throw a pass. The probabilistic edges are like reading the defense after the snap. You can't control what they show you, but you better know what to do with it when they do it. A great team does both. Engineering and athletic instinct working together. The team's portfolio, well, it's built that way at Tennessee Wealth Management. The bridge that is still standing in 30 years uses both engineering math and the engineer's judgment in the moment.
And that is exactly the model we use to teach this at our workshops, Erik. Speaking of which, and this is the right time to bring it up, we would love to see people at the next Organized Investor Workshop. It's at Chesapeake's on Parkside Drive in West Knoxville at 6 p.m., and we do these monthly. You get a real meal, you get a beverage if that's your style, and you walk out with a 60-page workbook that lays out every concept we discuss on this show. There's also a chance to win a football signed by Erik, which I will say has caused some more competitive elbowing in the back row at our workshops than we expected. We offer estate planning help to attendees. That's free. And I want to talk about that next because something has actually changed with that offer.
It has. And Megan, this is important, and I want to make sure folks hear this clearly because this is kind of new. Here's what we know about our listeners. Roughly half of everyone listening right now has done absolutely nothing to get their affairs in order. They've done nothing. No will, no power of attorney, no healthcare directive, nothing. And for the half who actually has done something, about half of those, basically all that information is probably out of date. It's simply inaccurate. You know, the kids have grown, the spouses have changed, maybe they've even in a different state. The laws are different. Whatever the reason, it's now wrong. So do the math. 3/4 of the people listening right now either need to do some estate planning from scratch or update what they already have.
Dad had to update his because my sister and I are now grown, obviously, at 45 and almost 40. But he's still, in his, designated me to be my sister's guardian and my sister to be my guardian.
They were and we all know Mo's getting everything anyway.
Well, Mo got left to my sister.
And that is the reason we made the change to how we offer this, Jerry. Through a partnership with our online provider, Trust and Will, we now have an unlimited subscription that lets us offer a complete set of estate planning documents to anyone, completely free of charge. So a durable power of attorney, a healthcare power of attorney, an advanced healthcare directive, and either a will or a revocable living trust, depending on your situation. And it covers you and your spouse or significant other. That is about a $500 value if you bought it directly from Trust and Will, and potentially several $1,000s if you used a local attorney. And you don't pay us a dime for it because we don't make a dime off of it.
This is appropriate for probably 95% of our listeners. And if you have a complicated situation, we can introduce you to a flat fee attorney that can help you with any of that. And here's the part that I love about how we have this set up. You can do the entire thing yourself. You can also do it with a little bit of help from the team, or they can help you a lot, including walking you through it in the office, printing the documents, signing, witnessing, notarizing, all in one single trip. One trip. No multiple visits, no big bill, no run around. You don't have to come to the workshop to do that, although we want to see you. You don't even have to come to the office unless you want to. But again, Jerry's pretty cool. The only requirement is a brief phone call with Jerry or Jared to make sure that you're not part of the 5% of people who may need help from an actual attorney.
And let me add, my dad has been doing this for over 2 decades. Jared joined the team about 6 years ago, and neither of them have ever been compensated for helping with this, okay? Not once, which means the guidance they give you is completely unbiased because there's literally no financial interest on their side. That is a really rare thing in this industry. So if you are finally ready to take care of this once and for all, you can call the office and ask for my dad, Jerry Goodman, or my husband, Jared Hubbard, at 865-415-2070. You can also visit our website, theorganizedinvestor.com, and find our email addresses there. Shoot us an email, and we will be happy to send you the link to be able to get this process started.
So let me add one more little thing why this matters so much. When someone passes away without their affairs in order, the people who really pay the price is going to be the spouse and the children. It's the rest of the family. They're the ones digging through the cabinets at the worst possible moment in their life. They're the ones standing in front of an attorney who's now charging them by the hour to figure out what they should have figured out several years ago. Folks, this is just not about paperwork, okay? This is the single kindest thing that you can do to the people that you love most, okay? And we will help you go through this. It's all free. We can even do it in one trip. There's no pressure. There's no agenda. This offer doesn't exist anywhere else that I have seen in my 43 years of doing this.
And the reason it doesn't exist anywhere else is that there is no money in it for the firm offering it. Most advisors won't touch estate planning unless it's wrapped into a 6-figure account being moved over to them. We just don't operate that way. We figure if we help somebody get their documents in order and they like the way we do business, maybe they'll call us when they want a real conversation about their portfolio. Maybe they don't. Either way, the documents are done and we sleep better knowing that we helped.
Now, coming back to that little casino math for just a moment, because I don't want us basically to lose that thread. The reason that deterministic edge matters so much is that it can show up whether the market goes up or down, okay? A lower fee is a lower fee in a bull market or a bear market. No mutual fund cost buried inside of that is a cost in a good year or a terrible year. Those edges compound silently while everybody else is kind of watching CNBC and panicking. This is how you build that 1 to 2% advantage that turns into roughly $485,000 over a 20-year period, say for a $1 million portfolio. Quietly, no drama, basically just like the casino.
And the flexibility piece is the one I keep coming back to. A mutual fund manager has to follow a prospectus. He has got categories, sleeves, mandates, restrictions, committees, tracking errors he is graded on. The team here, managing in-house, can pivot in a single day if a real opportunity shows up. That is how they were able to lean into the right AI software names when the sell-off hit a few weeks ago. That is how they are thinking about travel versus oil right now around the Iran situation, pulling back from companies whose customers travel and stepping towards names that benefit from higher energy prices. A mutual fund just cannot move that fast. And speed and moments of fear, well, that's part of the edge.
And folks, that is what I love about this show. We're not selling anybody anything. We're showing you the cards. The performance is published in the last 4 digits for real client accounts. The strategy is explained. The fees are clear. The estate planning is free. And the door is open if you want to walk through it. In our last segment, we are going to bring this all the way home to the table where you are actually sitting. Stick with us. We're wrapping it up. This is the Organized Investor Show brought to you by Tennessee Wealth Management on News Talk 98.7.
If you're interested in a more personal learning experience, join us at the Organized Investor Workshops. Erik Ainge and the entire team will be there. The next event is scheduled for Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
We're back on the Organized Investor Show on News Talk 98.7. It's me, Ainge, and if you've been with us all hour, well, thank you. Thanks for sticking around. If you just tuned in, here's where we're at. The casino is not afraid of lucky players. It's afraid of math. Card counters have a 1 to 2% advantage compared to the average casino guest. This team runs portfolios on the same principle. Small, repeatable advantages applied over decades equal real wealth. Jerry Goodman, 43 years, CFP, right here in front of me. Megan Hubbard, Jerry's daughter. Susan Ainge, my wife. And me, EA, Erik Ainge, overall nice guy, enjoy long walks on the beach. Anyway, I digress. The last segment is about you, guys, the listener, and the table you're already sitting at, whether you realize it or not.
And Erik, I want to start with something that might sting a little. We have been talking about the casino like it's a metaphor. It's not really a metaphor. The decisions people are making with their retirement money look exactly like the decisions bad gamblers make at a blackjack table. Same emotions, same mistakes, same predictable losses. The dealer doesn't have to do anything fancy to win. The bad players just keep beating themselves over and over, and the house quietly takes the chips.
So let me list a few of those little mistakes because I think people are actually going to see them rather clearly. Things like panic selling at the bottom of a market downturn is like having 17 in a blackjack hand and you're asking for another card. You've already got a decent hand. You don't need another card. But the fear got to you, okay? You got to have that other card, basically, and you would have won. That's what exactly every panic seller in March of 2020 did. That's what people did in October of 2022 when the banking crisis was going on. You know, that's what some people basically did 3 weeks ago during the AI sell-off. They had a winning hand, they got scared, and they busted it on purpose.
And chasing whatever's hot, buying the meme stock, the crypto pump, the latest AI mania at the absolute top, that is splitting a pair of tens in the game of blackjack. 20 was already a winning hand at the table, but you saw something shiny across the floor and split a perfect hand into two probably losing hands. Anybody who has ever bought a stock because it had already tripled in 3 months knows this feeling. You weren't investing, you were splitting tens, and the dealer was just smiling at you the whole time.
And here's my favorite one. We hear this one from people that come to us from another firm. Expensive insurance products dressed up as investments. Annuities with surrender charges, indexed products with caps you can barely understand, loaded life insurance pitched as retirement income. That is the side bet at the craps table. The side bet always has a worse house edge than the regular game. Always. That's why the dealer pushes it. That is why it's right there on the felt in big shiny letters. The fancy insurance product is a side bet. It is engineered to look exciting and pay the house, not you.
And there's one more bad bet I want to add to the list, Erik, because I see it constantly. Sticking with the same advisor for 30 years out of pure inertia. That is doubling down on a hand you never even checked. Listeners spend more time researching a new dishwasher than they do checking whether their advisor is actually delivering.
Oh, but Megan, he's such a nice guy.
Well, but I'm sure he is, but you're not making any money. We've had clients walk in with statements from firms they've used for 20 years and not one piece of paper that shows exactly what they actually paid or what they actually earned. 20 years. That is not loyalty. That is a closed deck. Loyalty without verification is just one more way the house wins.
And that's exactly right, Megan. And here's kind of the really sad part. When somebody really sits down and just does the math, they almost realize that they would always been better off just buying a basic index fund along the way. Not because the index funds basically are so magical, because the fees and the underperformance from those actively managed lineups were basically quietly subtracting 2% every single year, year after year. Same numbers we've been hammering about this entire show. 2 percentage points, compounded over 20 years. It's equivalent to $485,000 on $1 million account, gone quietly without a single statement ever ringing the alarm bell.
Well, and the people running those firms are not bad people, by the way. A lot of them are friendly. A lot of them are sincere. A lot of them really do believe they are doing right by their clients. But the math doesn't care how nice anyone is. The math is math. That is why our framework matters. You are not auditing your advisor's character. You are auditing the table that you are sitting at.
Now, contrast that with how this team is playing the same hands. Through COVID in 2020, we were buying. Through the banking crisis of 2023, we were also buying. The terror scare of 2025 back in the spring, we were also buying. And through the AI sell-off that went through the first part of 2026, we're out there selectively buying very durable companies, real cash flows, pricing power, not some speculative ones that basically don't even have a business model. So then we ended up in the Iran conflict. We ended up with some opportunities with travel, and basically we're able to get rid of some oil stocks. And this basically is a part of the process that goes into our whole system here. This is the card counter's mindset, if you want to put it that way. You don't predict the cards, you play the math when the deck shifts.
And those decisions are why those numbers we mentioned earlier look the way they do. Real quick, just to remind everyone, net of fees are trailing returns 36.3% over the last year, 19.3% average over 3 years, 13.3% average over 5, and 16.7% average over 7 years. It's all posted on the website with the last 4 digits of real client account numbers. So you can verify it, you can check it, and you can compare it to your own numbers. Most people have never done that comparison even once. And that in itself, that is the most expensive decision that they have ever made. Which brings me to what I'm calling the receipt test. This is the single most useful thing a listener can take away from today. I know we've said that like 5 times, but this one might actually be it. Call your current advisor. Ask one question. Can you send me a written invoice in real dollars, not percentages, of everything I paid you, your firm, and the funds you put me in last year? Just that, a receipt. That's all you're asking for. Hey, what'd you do? What did it cost? Right? And what you will find is one of 2 things. Either he sends you a clean number, in which case, good for him. You can compare it to anyone else. Or he can't produce what you're asking, and that silence is the answer to your question.
And let me tell you what most listeners are about to discover when they actually run that test. The advisor is going to push back. He's going to send you something that looks like a statement, but doesn't actually break out the dollars. He's going to say, well, the fees are reflected in the share classes, or the expenses are net of returns, or some other phrase that sounds technical but really means nothing. That is what a non-receipt looks like. A real receipt is a real number with a dollar sign in front of it. If you can't get one, you don't have an advisor. You have a salesman with a fancy title.
We've even seen the anger. Why are you asking?
Yes.
Why are you asking?
And listeners would think their advisor is the exception. He's that trustworthy one. He's the family friend, the person who always basically has taken care of them. These are the listeners who really need to run that test, because the family friend with no receipt is still costing you money every single year. The trust you feel does not subtract the fees. The relationship does not improve the returns. These are two separate questions. We're big believers in having a good relationship. We just think the relationship should also include a real number on a real piece of paper telling you, what is it costing you?
And the receipt test costs you nothing. 5-minute phone call, one question, one follow-up email. That is the entire investment. You will know more about your retirement after that 10-minute exercise than 90% of Americans know about their own. That is wild when you say it out loud. 10 minutes to know more than nearly everyone else listening to this show right now.
And once you have run the receipt test, here's your next move. Call us at 865-415-2070. Call Jerry. That's Jerry. This is for Jerry's version of his Ask Me Anything in 20 Minutes phone call. And he'll discuss our situation, answer any questions you have, and you can see if working together might be a good fit. I bet it will be. Our track record is on the website. You hear us say that, theorganizedinvestor.com. You can compare it side by side with whatever your current advisor has finally produced for you. That's the real comparison. That's the comparison no one in America does. And that is the entire reason we publish the numbers with the last 4 digits of the client accounts on the website. We want to be checked. We are inviting the comparison the rest of the industry runs from.
And this is the perfect time to mention the workshop again, because the receipt test is something we walk through in person. The Organized Investor Workshop is held monthly at Chesapeake's on Parkside Drive in Knoxville at 6 p.m. We feed everybody. There are adult beverages if you want one, and you leave with a 60-page workbook covering everything, including the worksheet on how to actually run the receipt test on your current advisor. We also do the estate planning offer for attendees through Trust and Will completely free. And one lucky person each month walks out with a football signed by Erik.
The crowd goes wild.
They might even run out.
Yeah.
But like we say, we won't chase you.
Yes.
If you would like to make a reservation to attend the workshop, because seating is limited, we have 2 options for you to do so. You can call our reservation line at 865-415-2058. Or visit theorganizedinvestor.com, and you will go to the workshops page on our website, and there you can click on a link, put in your information, and you will be registered.
And before we hop off this workshop discussion, basically, I want to make sure you understand this is not a high-end steakhouse pitch where we're going to hand you some leather menu and try to sell you an annuity after we give you dessert, okay? This is not Ruth's Chris. We're at Chesapeake's. Nice restaurant, food's great, atmosphere's great. The point is we're here to educate you, to give you some options, to help you make a more informed decision. Other firms in our area run these steakhouse seminars sometimes 3 times a week. And when it comes really out on the other end, it's almost there to try to lock you up into some sort of long-term product that has a huge surrender fee that could go 10, maybe even 15 years. That's not what we do. It's the side bet at a casino dressed up in a sports coat.
And we want you to come meet us. Come hang out. Get to know us a little bit.
And I would add, having sat in those rooms during my study time, you can feel the difference within 5 minutes of walking in. A pitch room is a sales floor. Our workshop is a classroom. You're not going to be cornered by anyone afterward. Nobody's going to ask you to sign anything that night. You are there to learn, eat, ask questions, and just leave smarter than when you walked in. And if you become a client, great. If you don't, also great. That is genuinely the bet they are making. That education sells itself when it is real.
Folks, here's where I want to land this plane, which I always thought I could fly a plane. I feel like I could do that. No one's ever asked me to. A quarterback can have all the talent in the world, but the great ones, the ones that win in January, not just in October, they understand the math of the game better than anyone else on the field. Down and distance, timeouts, field position, coverage tendencies, personnel groupings, what the tendencies are of the other team in every single one of those situations. Well, that's math, guys. Math wins football games. Math built every casino on the strip like we're talking about today. And math applied patiently over decades builds retirement accounts that don't blow up the first time fear hits the market. The team here is not trying to get lucky. They're trying to be the card counter. Quiet edge, repeatable edge, long horizon.
And the question we asked at the very top of the show is the one we're going to leave you with. Which side of the table are you on? Are you the player who knows the math, or are you the one the casino was built to beat? The honest answer for most people is uncomfortable, but the good news is you can change tables. You can call. You can show up to the workshop. You can get the receipt test information, and you can run the receipt test on your current advisor. You can get your estate documents in order at no cost. None of this requires anything but a phone call and just a commitment from you of your time.
So the phone number, 865-415-2070. That is Jerry's phone number. That would be me. Pick up the phone and ask for basically the estate planning link. Ask for the workshop seat. Ask for a real conversation about whatever happens to be on your mind at the moment. We have been doing this estate planning thing for over 2 decades. We have never charged a dime for helping people with their estate planning documents. We don't pitch annuities. We don't lock you up in things. We don't sell you funds. We manage roughly 95 different stocks in the portfolio at the moment, about 1% each, mostly dividend growth stocks, but also with the flexibility to move them when the math shifts into some other areas. That's the whole deal. Nothing hidden about that.
And I will close with my favorite part of the whole framework, just because it makes me smile every time we say it out loud. The casino makes its money because the average gambler thinks they are playing a game of luck. Well, they are not. They're playing a game of math against a house that has already done the math. The same is true in retirement planning. Most people think they are investing. Well, they are not. They are making a series of small, emotional, predictable mistakes against a financial industry that has already done the math on them. The point of this show is to put the math back on your side of the table, guys.
And that's the show, ladies and gentlemen. The casino fears math, not luck. The team here uses both deterministic edges, lower fees, and no mutual fund layers, and probabilistic edges, selectively and buying during fear to create that 1% to 2% annual advantage. On $1 million account over 20 years, that 2% is roughly $485,000 additional dollars in your pocket. Performance, all posted publicly, theorganizedinvestor.com with the last 4 digits of each client account number right there. And again, you hear us talking about them, the workshops. Workshops are at Chesapeake's on Parkside Drive in Knoxville every month, 6 p.m. Estate planning documents, you'll hear about it there. Estate planning documents completely free through Trust and Will and the partnership we have with them. If you want to call 865-415-2070. Jerry will pick up the phone, talk to him, chat a little bit, run the receipt test on your current advisor or whoever you're with right now. If they can't produce real dollar invoices to you, so you already know what you have, what it's costing you, and what your performance is, then you got your answer. If they won't even give that to you, that's your answer. But if you get it, you can compare it with what you see at theorganizedinvestor.com. Sign up for the workshop. And again, make sure you're here next week. Same table, same dealer, same math. It's us, the team at Tennessee Wealth Management, with the Organized Investor Show on News Talk 98.7.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes.